Happy New Year and welcome to episode 28 of the Capital Spotlight podcast. Your host, Craig McGrother, the Director of Business Development at Lone Star Capital, with the one, the only, the principal, the founder, Rob Beardsley, two-time author. How are you today?
I'm good. Feeling great. How are you?
Incredible. We're actually going coast to coast today. I'm in the remote Bend, Oregon location. For those of you who come out to Bend, Oregon, actually let me know if you do, if you're ever in that Sun River area, the Crosswater Golf Course area, in that vicinity, let me know. I'd love to meet up with you. I actually met up with one of our capital partners here when I was in town last. I come out here probably for at least maybe 3 weeks a year, but roughly about a month a year, usually in the summertime to avoid the Arizona heat. But right now I'm here for New Year's to get away and to reset. And you, of course, are in the home flagship headquarters of Lone Star Capital. But a quick view check here. I'm actually a little bit bummed out that there's no snow on the ground. Just a little bit bummed out.
It's actually warmer here in New York than it is in Oregon or Phoenix. So it's pretty great out here right now.
Really, we talking about the 50s right
We're in the
now?
50s right now.
Wow, wow, well, I love that. Well, we've got a jam-packed show today, so let's get into the agenda. Business and personal goals for 2024. We'll probably just briefly skim on that. Accredited versus non-accredited talk, because we've got a new deal, Aspire in San Antonio, which is in fact a 506C. So we'll get into the nuances there. And also maybe a couple loopholes to help people get to accredited status if they're maybe not accredited. And then sensitivity tabs on the underwriting model will show you the actually specific deal that we're working on, and also, frankly, how much you can skew or not skew numbers depending upon that. And then also incentives of the sponsor risk, hire promote, and whatnot, and the relationship with that. So we're going to dive into that. So leading off with business and personal goals for 2024, we kind of mentioned that, I believe, last show with our goals as a firm. We wanted to get to 300 million, but frankly, I want to get to higher than that as a firm there. But more than anything else, on my end, for just business goals, I'll go and get into my personal business. I want to continue doing the podcast. Obviously, that's just the show, and the train's not stopping on that. Fun Friday, of course, and the Capital Spotlight. So if you are a fund manager, please let me know on that. So yeah, I mean, that's kind of my plan there. 300 million would be the minimum that I want to hit. I think we should be more aggressive personally, especially as the latter half of the year kind of unfolds. Assuming we can raise the equity, of course, it makes sense. And if we have got to take pref, maybe we'll have to take pref to do a deal that we love. And then personal goals for me, I want to have it be more kind of just physical, as obviously on top of work and stuff. But for health, I want to get to staying around the physique that I'm in right now, which is kind of sub 190 pounds, so 180 to 190 the whole year. It's kind of a goal of mine. And then want to invest a lot of money as well too this year coming up. So really deploy equity and capital, roll all my acquisition fees back into the deals that we're doing, because I do think it's going to be that spectacular and that unique. And the fruit of that labor and the sprouting of that seed will really pay dividends long term. So those are just quickly some of my goals for Lone Star, and then obviously personal goals there. How about yourself?
Yeah, so as a firm, we've done a good job of growing the foundation and we're going to continue to invest in the foundation. So operationally, one of the biggest goals for the firm that Kent and I are really leaning into and excited about are hiring a controller, which will help uh, really all of the asset management and reporting initiatives, of course, sitting on top of the accounting, which we're bringing in-house. We've already hired an accountant. So we're bringing accounting in-house, and that starts actually January 1st. And that's going to be a great step to changing and improving our accounting, asset management, and reporting process. And they all interlink. I mean, the business all interacts, all the different departments interact with each other. And so we see that it's very important that we get this right as we scale, because the worst thing you want to do is grow at any cost. And then before you know it, you're at 50 properties and everything's falling apart. You don't have good systems in place. And that's when it's really a nightmare and it could really cost you. So right now is the time to be investing in our people and in our systems. Even if right now we look at it and go, oh gosh, a controller is expensive, or if we're going to overhaul our accounting process and our investor reporting processes, right? That's a big time investment. But those are important things to do, because if, let's say, a monthly or a quarterly report per property takes X amount of time, okay, well, X times 15 properties right now is no big deal. Well, it's still a lot of work, but it's manageable. But X times 50 properties, now that is overwhelming. And that is going to require us to hire more people and to struggle and juggle more. But if we can get that X, which is that unit of time per property of accounting and reporting, if we can cut that in half, let's say, or even more through the utilization of artificial intelligence, which is another thing that we're investing in, that can set us up for long-term success. So those are kind of things that behind the scenes, it's not as sexy. You're not going to hear about it as much or see the headlines, right? We're not going to be posting about it on LinkedIn, like, oh, we closed this deal, right? Or we revamped our accounting process. But nevertheless, it's a really important goal that we're kind of working on behind the scenes. So aside from the headline number, of course, 300 million in acquisition volume, some things behind the scenes, we just want to make sure that we build the foundations correctly. And the accounting and reporting is a big project for this year. Similarly, just some kind of smaller add-on projects like bringing HR in-house and revamping some of our payroll functions and capabilities. So those are some things behind the scenes. Another big thing for me, mentality-wise, in regards to our acquisition goal is how do we get to 300 million? Because you can get to 300 million in lots of different ways. You could do 30 $10 million deals. Well, that sounds like a huge headache.
Yeah, it sounds
And
terrible.
it's probably not even possible, right? It's so time consuming each deal. And that's another thing that I'd like to invest in and improve is our transaction coordination. How can we close deals faster? How can we close deals more smoothly and avoid delays? Investors don't like delays. We want to have a good investor experience, and delays are not included in a good investor experience. So if we can move quick and under promise and over deliver on that front, that'll be a great thing. And it will help us actually do more business throughout the year, right? The faster you close, the more you can do. But anyway, the big thing I want to work on is giving ourselves the confidence to pursue larger deals. And I know we just closed over $100 million deal not too long ago. But funny enough, I don't feel, and maybe because we went through so much through that deal, I don't feel like I gained a ton of confidence. I feel like typically people would assume, oh, you just closed $100 million deal. You should be on top of the world. Now you should think you're the man and you can chase bigger and bigger deals. Well, I don't know. Maybe there's something wrong with me, but I don't feel like that. I still feel like, wow, we have to scratch and claw and I'm scared to do another $100 million deal. They still scare me. So with that in mind, I think it's really important that it's not just achieving our goals, but it's how do we achieve them? And I want to achieve them in the optimal way that's smooth and safe for us and our investors, and return on brain damage, right? Reducing the headache. So $50 million deal size is a nice deal size, and that means we're doing 6 deals in a year. If we did six $50 million deals in a year, that's a very nice, just straightforward year where we're doing a deal every 2 months, just nice and steady. And that feels really good to me. So I want to push
That's a great
ourselves.
cadence. Yeah.
Right. It's a great cadence. It's a great quality of life where we're not pulling all-nighters and stressing ourselves out or risking losing millions of dollars if we can't actually perform if we're juggling so many deals. So those are the things that we need to keep in mind as we look to balance our desire for growth, right? So a great solution to kind of summarize is pushing ourselves to do bigger deals. That's the reality of the business. This business scales well for a reason. That's because you can simply add zeros to your deal size and it doesn't really take that much more work. Where there's more work is on you because we have to go out and raise more money and partner with more investors, which is the name of the game, and that's what we do.
So to that point, I will say this is that yes, technically maybe more work for me, but I don't think anything will be as daunting as what we experienced with basically raising for the three property portfolio, the $105 million deal twice in a very challenging market. So I don't think it's any task that I'm not up for, especially with the momentum that we have with equity. I think we're up for it and we've got to challenge ourselves at some point. And I think it's all about picking your spots in life. If you're a gambler, you know that, hey, there's certain weeks where a team might do well from an emotional perspective, whatever. And if there's a business time where, hey, there's a time to pick your spot, there's a time to go in and really challenge yourself, push yourselves. I think the economics and the landscape really makes for a great time to do that today and in the new year and in 2024 and 2025. So the work that we do right now will only just be that much more beneficial and it'll work itself out. My question for you on all of that is, is there a certain deal size that you feel is kind of looked over? Because we're in that mid-market space, right? As you know, mid-market is like what, 15 to $50 million deals. It's probably too big for a mom and pop owner operator, but too small for the massive REITs of the world, right? So we're in that market space. But do you think there's a kind of an acquisition gap that is kind of skipped over or has a little less competition where there's some juice and value there?
I think there is. I think that is somewhat nebulous, but and also dependent on asset class as well as just the market conditions. So right now we find ourselves in a very interesting spot where the capital that's on the sidelines is predominantly institutional capital. So institutional capital is pursuing a certain deal size and a certain deal quality. So if you can avoid what they're targeting, or so they're on the sidelines. So if you can target what they would normally play in, there's really less competition there. So the larger deal sizes right now are a great place to be because there's just less competition. The institutional groups are largely on the sidelines, and that's, as you know, is what is allowing us to be successful on another acquisition that we are lining up in Houston right now. So that sort of deal we would not really have the opportunity to buy because it doesn't really fit our risk profile. Generally we pursue deals that are riskier than that. And I know that sounds weird to some people listening because a lot of people hear risk and they think of risk as a bad word. But the reality is you can't honestly expect a good return if you're not taking risk. And so, for example, I could present you the best investment opportunity in the world. And I could say, hey, this deal has zero risk. It's the best investment opportunity in the world, but it's going to only return 8%. It's no risk, but it's 8%. You would say, yeah, I mean, that sounds okay, but I'm not in the game for 8%. I'd actually want to take more risk so I can get maybe more than 8, right? That's the whole concept of investing. So what we do in our business is, generally speaking, cater to investors who are seeking higher returns and therefore are seeking riskier investments. So with that being said, of course, our job is to have risk under control, right? And to manage risk and to only take thoughtful risk.
Yeah, and with that said and noted, it's very interesting because I see this on my end a lot, and people evaluate risk differently from a capital partner perspective. Some people don't want to raise for a deal that shows less than a 20 IRR or less than a certain threshold, which we're going to get into, of course, coming up here with the sensitivities. But as we both know, and I really want to educate a lot more people on this, investors, capital raisers, is that every deal is created differently. I've said this 1,000 times, and I'll say it 1,000 more. But if you give the same deal to 10 operators, you can get 10 different numbers and results because everyone underwrites differently. Everyone put different outputs in or sensitivities. Some people more or less aggressive. We'd rather kind of underrate where we think the deal is going to come in, or at least be, pretty accurate, but we don't want to embellish because we know we have the answer to those numbers at some point. If we've got a track record of a decade worth of deals and we tell everyone it's going to be 20 and they end up being a 15, well, 15 is incredible, but the issue is that you told everyone it's going to be a 20. And if you're, X amount of points off on the low end every single time, that does not bode well. But similarly, if you tell everyone it's going to be a 14 and you hit a 17 every single time, well, you may struggle to raise capital, but everyone who wants to get a 14 but ends hitting a 17 thinks you're the best thing since sliced bread, right? So it's a very interesting balancing act that we have to play on that one. And everyone wants to create the numbers and put numbers differently because, people want to get, outside of normal returns in an investment like this. So, it's very interesting how that all kind of plans out and how people perceive risk. And I actually don't think people have a healthy understanding of risk. And I didn't either, really. I think it really took me about, frankly, a full year to really understand the components in which a deal is created. And it's funny how I look at things differently now than I would a year ago or 6 months ago in my perception of the game. But, that's on the risk side. I definitely want to be aggressive in the next year and 2 years just due to the shift of the market.
Yeah. And I think it's interesting how you can read about these concepts and you can study history and understand cycles, but nothing teaches you better than the cycle right in front of your face. So you can be in the game for years, but if those years didn't include a cycle, which is what we're going through right now, it's very difficult to say that you really understand risk and understand how the market cycles and those dynamics. So we're very fortunate to be learning that lesson right now. And that's going to serve us and I think actually shape our outlook on the market for the rest of our careers. So very grateful for that.
And it'll also shape our partnerships too, because the people who are with us right now that see what we're doing, see the hard work, where, other groups are frankly probably, and we wish this upon no one, are a lot more of distressful situations than us, considering we're distributing on 14 to 17 of our deals. They're going to be the ones who look at us like, wow, you know what? When the dust is settled and everything is rosy and normal again, and fundamentals are fine, and capital calls are kind of a year or two so old, hopefully. I think people will really appreciate what we're doing. And to further the point of the business goals that you've set up for Lone Star in the new year with you and Kent, obviously with the in-house stuff on your end, with setting up our systems, putting everything in place, we're able to really get everything dialed up from a back end and behind the curtain perspective that will allow us to grow out a lot more. And, on my end, my work is kind of constant. It's say whatever the deal is right in front of me is what I'm raising for. And then obviously we've got the shows, we've got the travel, and then the new relationship building and partnerships and, kind of strengthening what we have currently. My end is kind of constant, but really multiplying our in-house, going from let's say 17 to 34 deals, doubling up our portfolio from 17 to 34 and call it a 2-year, 3-year span, which is very realistic. That is, legitimately double the work and compounding in that regard, but my work stays the same. So just setting up the right systems in place to make sure that we can grow accordingly is great. And I'm really excited for the next couple of years because I think we're really going to shine. So it's the less sexy things like, and the tough decisions like pausing distributions when we paused them, kind of going out on that limb, being the first there that will pay us, really great dividends. And, I think will yield us, a lot of great results, but also will curry favor with our partners due to the decisions that we made before. So I'm just excited about that.
So before I go over to personal goals, I'll just finish with the point that everything you said, I really like. And what I'll add is we're not, and you know this, and everybody knows this, we're not through it yet, right?
No,
We're
not even
still
close.
not
Yeah,
even
not even
close.
close. Yeah.
We're still going through it, and there's a lot more distress to get through, and even groups that are relatively well positioned like us are still going to deal with challenges because I don't know what the consensus is, or I don't know what all the people listening think, but I definitely see a recession around the corner. I don't think it's going to be a sharp one, but there's definitely going to be a softening in fundamentals. And at this point, we've already seen it. We've already seen that rents have softened, occupancies are down a little bit. And hey, that's fine because the reality is rents can't go up at breakneck pace every single year, right? And we've been spoiled with good fundamentals, but the reality is we're seeing record high multifamily supply since the 70s. I think this is the highest supply level hitting the market since the 70s. So yes, there's a ton of demand and long-term housing is just such an amazing investment in America because of population growth, because of job growth. However, supply can wreak havoc on the market, and that's going to definitely take some time to absorb. So actually, and that reminds me about one other point that I want to make, which is another side point, but I think this is really interesting, is all this supply is going to obviously be Class A product. I mean, maybe some of it is more like basic, affordable type product, and it's kind of more like B plus, A minus product. But we're talking about brand new deals, obviously, being constructed and delivered. And so, what does supply impact the most? It negatively impacts the most its direct competitors, which are fellow Class A properties. So what I think is, well, that's also where the strong tenant demographic is, and that's going to be the more resilient tenant base that's going to be able to afford those rents and be able to afford staying put and not have to move out and whatnot. However, I think those are going to be some really attractive buys where you're going to be able to buy brand new deals hitting the market that are going to be struggling, and you're going to be able to buy deals at a discount to replacement cost, brand new deals at a discount to replacement cost. So I think that's a really attractive investment thesis heading into the next year or two. However, not that I worry about this, but I'm just bummed out that that's not really our target. We don't generally buy brand new deals because like we talked about, they don't have enough risk there, enough meat on the bone for us to go and pursue great returns. And so the distress level and the discount would have to be great enough to allow us to buy those deals and still project mid-teens returns for our investors because that's generally speaking what our investors want. And then the reason why I say I'm bummed out is my dream, right, is eventually to get to a point where we have those investors that are conservative and long-term minded that are comfortable with buying great product for a fair price and only project or only aspire for a 10% return, right? That is
So
a different type of investor.
I have so many thoughts to that. And I just want to make a PSA right now to every investor out there right now. And we have to wrap our heads around this from an expectation management perspective. And that's this is that if you are seeing a 18 to a 22% IRR with fixed rate debt, without floating rate debt, with conservative inputs, that's a great deal. But with great deal is going to come probably some sort of distress at some level to get, those massive returns. So where that distress is likely going to come is in the first year or two and 3 years of the 5-year hold potentially of, tough property management level issues and asset management issues where rents are softening with where we've got to do concessions maybe for rent and whatnot. So I just urge caution and, tampering expectations on maybe the cash on cash return and what the deal looks like. Because when you are investing in risky environments and when you are trying to catch the falling knife, the market's kind of going down or staying stagnant, is when on an operations perspective, it may be a little bit turbulent for the short term. But then, the exit will look like a more fruitful and stabilized market. That's where the money will be made on the departure. And obviously the cash on cash will help as well. But just there could be a deal where we invest in where, we think it's going to be easier on an expectations perspective, excuse me, but maybe a lot harder. And the deal might not be as fun in the immediate in the short term, but know that in the midterm, which is a 3 to 6 year period where we plan on exiting it, is where you'll be very happy you made that choice and that decision to invest in said property. And then to your point about the shift of going in from riskier assets to a more, lower teen to maybe a single digit IRR with, really, really quality real estate. I feel as if that will happen maybe in a cycle or two where we'll hit some, kind of grand slams, home runs on some riskier, maybe junkier kind of deals where we potentially take out a bridge loan, maybe a 2-year deal, hit a massive lift, hit a massive return, and then boom, go transition into a more stable deal that's maybe a 2010 or sorry, 2000s to 2015 build, maybe even newer one where, hey, you hit a 30 IRR in a 2.5 year process, you basically 2x your equity, and then you kind of roll into something safer. That's something that I would like to do is going risky to go safe process. Perhaps there's a potential outcome in which you hold that next deal and the cycle changes. Well, if the cycle changes, you'd rather have the better asset as opposed to the, junkier 70s, 80s vintage because, hey, in the 30s, most people aren't going to want to be, owning 70s assets because that's just going to feel too old. That'll be 60 years old for them. So that's kind of my dream is to go a little bit riskier in this point and then transition into a more stable asset. And, personally, for selfish perspectives, I would like that because, hey, at that point, all I've made kind of some money on the fees, and I'd rather have my money in more core and stable real estate as opposed to always risky, because I just don't want to get wiped out and go backwards. I want to just basically hit singles and doubles every single time. And hopefully we build and attract an investor base who feels similar to you and to me in that regard.
Yeah, that's exactly right. And that's hard for investors to always gravitate towards, right? Especially when they're being pitched by other groups that, oh, well, you can go make a 20 with us. And investors sometimes look at the headline number and then they don't dissect the business plan and the risk behind it. And similar to that point is I would just be at this point in time, we talked about it, the recession, the softening in fundamentals. You have to be very, very cautious with value add plans today. This is not 2 years ago where if you just if you brush some light paint on the interiors, you're raising rents $200. That's not happening today, and that's not going to
If
happen over
you
the next two
paint
years.
if you paint your you're building off-white cream or white, and then a black or a brown trim, you've instantly created, a 20% bump in rent. Well, that's just, market beta raising. That's not just some little paint, right?
Yeah. So I would just be cautious of buying into business plans that are aggressive. I'm not saying value add is a bad business strategy. Obviously, fixing up a property and adding value to it's great. However, if you have to pay a compressed cap rate for it, then what's the point? And so, especially right now, I'm very, very against paying compressed cap rates right now for value add. And this is just something that is I really feel strongly about in the market because people are out there still doing or they still have that value add mindset where everything they have a hammer in their hand and everything looks like a nail. Where can I put value add? Where can I do value add? And the reality is you're going to be a sucker because someone's going to sell you a deal that is quote unquote a value add deal, but they're going to sell it to you at a compressed cap rate and your stabilized yield on cost is going to be no better than if you had bought just actually a newer deal that was not value add, cleaner and less risk. So I feel very strongly about that point that
Well, what you're talking about is basically not getting paid for your work that you put in, which sounds exactly like something we may or may not have in Houston.
yes, it sounds exactly like that. I love those numbers, love that deal, love that profile. So we'll hopefully talk about that at a later time. But yeah, I think we need to move on with stuff. There's so many interesting ways to talk, and I think this correlates to another topic that we'll save for another show, which is the concept of as a sponsor we're incentivized to push the risk envelope because we make more promote when there's risk. And then there's that classic tug of war or that push pull between sponsors and investors. And investors can call out a sponsor and say, oh, well, you're just pushing risk because if the deal goes well, you make a promote. If the deal doesn't go well, you don't lose any money, but I'm the investor, I lose money. And that is a perverse incentive. But at a later time, I want to fully dive in, but I'm just kind of teasing that concept. And I actually want
Well,
to counter that concept because I don't buy that at all. Because as a sponsor, I would rather lose money than lose investor money. And I would rather and lose my reputation. So I think that actually as a sponsor, and this is just our personal philosophy, it is totally not worth it for us to push the risk envelope to make a little bit more promote down the road in and face the risk of perhaps having a deal underperform and then losing the trust of those investors. I mean, that is to me untenable.
well, you just actually had the best segue of 2023 and 2024. I'm going to give you that award because that goes directly into the next topic, and this is a little bit out of order, but let's just get to it. And
Well, I
that's
didn't talk about
uh,
personal goals.
oh, okay, gotcha. Well,
Yeah.
we can go back to that. So let's finish that note then on personal goals.
Okay. All right, cool. So there's a couple things here, and I want you to hold me accountable to a few of them. So I
Everybody, every Capital Spotlight listener, hold them accountable. We'll audit this in the new year in 2025, but let's hear it.
so starting when I was 18, I started meditating every day, and I felt a big impact on my life from meditation. So I definitely believe in meditation, and I am, uh, bought into it. But for some reason, I just stepped away from meditation, and I totally fell out of rhythm. And so I really want to bring my goal for 2024 is to bring meditation back into my daily routine. There's no excuses. Meditation, journaling, gratitude journaling, goal journaling, affirmations, self-image statement, all that good stuff. Really happy with that work, but getting back into meditation. And Hunter Thompson talks about this on his stuff as well and talks about how it's such an asymmetrical return. You just meditate for 10 minutes and then the rest of your day could be changed from that, right? And then there's physiological elements as well. Studies actually legitimately show that your blood pressure goes down through meditation, et cetera. So simply, I want to meditate every day. That's a big goal for me. And then and preferably in the morning. So I wake up, meditate, and then to bookend the day on the back end before bed, I need to, this is a tough goal for me because I just keep on slipping, but I need to get my phone out of the bedroom and I need to read before bed. Replace the phone screen with the Kindle screen or a hard book and get some good reading in and get better quality sleep, get the phone out of the bedroom. So those are my two uh, kind of habit personal goals. And then the big goal for 2024 is I'm 26. I turned 27 in
Drum
2024.
roll.
Drum roll, please. It's time for me to really start making an effort towards building a family. I need to meet my wife. I need to meet my forever person, and I need to have some kids and get things going with the family side of things. That's my next level of growth. So it's kind of crazy
Hey,
to
to
say.
everyone, yeah, everyone out there who may or may not know an eligible bachelorette that is preferably, well, I want to get into preferences, but if anyone knows anyone who is a eligible bachelorette who's looking for a absolute stud, a family man, a guy who's looking to get serious, he's 26, turning 27 here on February 15th. Let him know he is in business looking to start a lovely dynasty and family. My hope for you is to have more than two kids, but that's just me.
Yeah, yeah, I hear that. I hear that. We'll go for two and maybe three. So
Exactly.
yeah, no
Well,
rush.
my
You can't rush these things, obviously, but at the same time, if you're not intentional with your goals, then how can you expect to achieve them? So I I think that this is a daunting thing. This is, in my opinion, the biggest
It
decision
is
of my
of your
life,
life.
and that is important. But yeah, I have the confidence that throughout my life I've set goals and I've achieved them, so this shouldn't be any different.
Yeah, well, and the other unfortunate thing to think about this in reference to your goals is that there are personal goals. Like if you play golf, right? It is an individual sport. But on team sports, it takes a team. There's other people that have their assignment and their roles. So there is just the circle of control, no control. And it sounds like you're trying to focus on the things you can control, which is being more intentional about your dating preferences, kind of stating what you want, and then you saying, "Hey, I want to be intentional about finding this." Now, it could take 3 years, take 5 years, it could take a decade, it could take 2 months, frankly. So you just never know what God has in store for you, what your plans may be. But I think being intentional about it today will set you up better for the future. And obviously, no rush, but to have that top of mind is great. And I think similarly to yourself, and I just know I don't have the brain that you have. I have to be fully focused and all hands on deck and very intentional with my time and my day to day to hit the goals I have financially, personally, and then also feel the way I feel. I'm very active into fitness, and I just can't be messing around doing nonsense. And similarly, it's not like you are too, but it really just feels as if the new year is going to be all about being intentional. I don't know if that's the said mantra for 2024 is the year of intentionality, but you and I are looking around, trying to, acquire 300 million of real estate next year. And that's going to take an all hands on deck effort and, wasting time on, things that are not compounding, whether it be just, certain transactional little relationships, nothing that has a long-term goal. It's just, there's no point in that in my life anymore. And it seems as if you're there as well. Granted, I'm a little bit older. I'm 29. I'm the L statement of this podcast. But it's great to hear that as a friend. I think it will only benefit the firm, and obviously just you personally to enrich your life. But similarly, it's just where our heads are both in the right places of, wanting to really just make sure that we are set up and are putting our time into things that will actually last and matter and are beneficial as opposed to just, you know, unintentional, nonsense, I guess, for lack of a better term.
Yeah, you have to be intentional if you want to achieve your goals. And the first step is to set the goals and then to actually put one foot in front of the other, right? You break a goal down from the long term. Here's the high level goal. Okay, now how do I chunk that out and break it into smaller pieces that I can actually do every single day and keep it top of mind? That's the other important piece. All right. So do you want to transition over to accredited investor at 506C versus B, or what do you have for us?
Well, I think we were really close and on to something great prior to me forgetting about the personal goal aspect we wanted to talk about, of course. So I think we should go back to the incentives of a sponsor and the risk there and the higher promote. And this is something I think is very interesting. And, this is just a theme that, really gets hit on and I'm kind of really in the weeds on, which is just, maybe the promote being a little lower than someone would like on deals, but, looking at other deals, maybe have a higher promote, but what's the risk tolerance there? What is the potential outcome? What's your downside? I look at things more now. So as the downside, what's the worst case scenario? Playing with our sensitivities and whatnot, as opposed to what's the best case scenario if everything's going well there. And I think you mentioned before about, as we said, not getting paid for work, with the value add and whatnot, just basically buying more core real estate knowing that, having a good basis, that coupled with market beta, riding you up is just going to create a better investment vehicle than, ultimately trying to, do a massive value add play where you're hoping rates get cut and you're kind of just betting and speculating on better timing as opposed to better fundamentals. So if you want to get into your spiel about, I guess effectively, the incentives of a sponsor risk and hire promote and what that looks like, I would love to know where your thoughts are as it pertains to that.
Yeah. So I was kind of just teasing it, but we'll dive into it now. The concept for those that aren't familiar is people view a sponsors promote as an option, and an option like in in financial theory or as a financial instrument in the markets, an option is basically you pay a small little price in exchange for the right to buy something in the future. And so, anyway, I'm not an options theorist or trader or anything, but basically, the way I'm trying to explain it here is you put in a small piece of capital with the opportunity to make big profit. But obviously, with that sort of asymmetrical risk and return payout is a big risk. So, from the sponsor's perspective, right? Let's say the sponsor's putting in a little bit of money into the deal, they raise money, and then if the deal goes well, their promote is this big relative to the amount of capital they put in. Obviously, they put in a lot of work as well. So there's a conflation between services rendered by the sponsor versus capital put in. So there's a conflation there, but generally that's the concept is okay, the sponsor could put no money in. The deal goes well, they make a big promote. The deal doesn't go well, they make nothing, right? So it's no big deal, right? They didn't put in any money or they put a small piece in and the deal doesn't go well, no big deal. So that's an argument that investors sometimes make against a sponsor and they don't like that dynamic and they say, well, you're incentivized to push the risk envelope because the more you push risk, the more you can make, but your downside is not impacted, right? And like I said
Well,
earlier, go ahead.
yeah, that just gets back into why a lot of, big institutional groups and equity providers and sources want to see a larger co-invest and skin in the game because, hey, we want to see you put risk in. Some groups want 10% or 20% in, which is absurd on a larger raise. If it's a $40 million raise like we just did, oh, so we're going to put in $4 million. Very tough, but to your point, that logic kind of goes to there where, if we're going to risk our money here, you darn well better be risking your capital too and your reputation.
Yeah, I think the reputation piece and this line of reasoning can be seen as self-serving, but I just think that requiring a 10% co-invest from the sponsor, which, like you said, on a big deal could be $4 million, is insanity. I mean, the how could it be possible that I would have that much money to invest in that singular deal? And then guess what? I'm doing 5, 10 deals in a year. So, I mean, what am I investing 10, $20 million per year? I mean, that would be great. And I hope to get there. But as a growing firm, it is irresponsible, in my opinion, to plow that much money into every deal when I could be taking that capital and using it to hire more people, build up our infrastructure, and provide a better service and ensure a better outcome for these investments. So I think that it's tough, right? I get where an investor is coming from because they're solving for that asymmetrical risk issue. They're saying, oh, well, you have this option via the promote to make a lot, and if the deal doesn't go well, you don't get punished. I need you to put money in so that way we're riding in this deal together, right? And that's one way. But I think at the end of the day, and this is true with all relationships, you can't manufacture trust. You can't manufacture alignment, right? If you bind someone legally or structurally into something that they're not really bought into, it's going to break at some point, right? So that's why I really preach trust with an investor, with a sponsor vis-a-vis the investor, as well as the concept that our reputation is so important that it's worth more to us than any co-invest that we could be putting into a deal. So I know that sounds it's easy to say and it's self-serving, but that's just my strong belief about this dynamic. And that's how you really build the most successful business rather than trying to contort
Well,
the deal and the structure in such a way that people can feel comfortable. Like if you don't trust your sponsor enough, and in order to feel more comfortable, you have to force them into a pretzel, then I don't think you should be investing in that deal anyway.
well, it's funny, and I think we'll be able to hit the co-invest allotment and amount as we go full cycle and more deals, as we've spoke about before, because hey, once we do hit promote and we do well in these deals, we will have excess surplus capital where the whole firm and entity will roll in. I mean, on my end, if I'm making X amount of dollars on a promote for a deal, well, do I want to get taxed on it, or do I want to roll that into the deal and get a dividend on that and defer it and let my money compound and grow? Well, naturally, I'm going to do that, but me throwing in that coupled with maybe the acquisition bonus on the next deal we're rolling into, well, that coupled with everyone else doing that too is obviously pretty substantial and large. So that's something to think about on that end, and we will be able to hit that allotment, I think, a lot more seamlessly and with less pushback once we do go deeper with these deals. So that is important. But I guess you're debunking the myth that your parents aren't super rich, where they can give you $4 to $5 million for the friends and family co-invest, like are all of your TikTok fans say.
Yes. I don't go on TikTok, and I'm sure many people listening aren't on TikTok either, but we post short clips from our podcasts and other things on TikTok, and Dasha lets us know that there's some funny people commenting, or haters even commenting. So I don't really worry about the haters. I actually think there's a problem if we're not getting haters. So when the coast is clear and the comment section isn't active, I get nervous. Where are the haters? So
Yeah.
anyhow, yeah, to I don't know, spoil or to counter the rumors. My parents aren't super rich, and this business isn't funded by them, unfortunately. That would make my life a lot easier. I love how people call out somebody's success and say, "Oh yeah, well, they probably have a rich parent, something, right?" And me and you joke, say, "I wish,"
I
right?
would, yeah,
Like,
I would. Well, wouldn't it be cool if my parents were, I guess, 10 times richer? Not that they've not done incredibly well. I'm really sitting in such a shack here right now, right? But wouldn't it be better if my family was just more well off, or yours was too? Who wouldn't wish for that? That is just the stupidest thing ever. It's like you just know someone's in a negativity loop, but I'm not someone here that would ever randomly comment on something. But those who are probably commenting on the internet have a little less going on, or are likely on the more bitter end of the spectrum. So it's all good. It's actually the biggest compliment that they're noticing would take their time and energy out to, keyboard away. And, also on my end, I've gotten ripped in the comment section of YouTube here, which I'm so grateful for. Thank you so much for calling out my flaws. If you want to get me better and coach me up there, please let it fly. I'm sure I'm making tons of errors in this show. I mean, heck, I said 26 when it was episode 28, and I'm sure I've interrupted you a couple more times than what the fans would like to see so far in the show. But hey, that's it's show business, right? So it's not easy out here being a content creator and influencer.
I hear that. I hear that. Yeah, times are tough. Life is hard. It would be a lot easier if our parents were very rich. So
Yeah, exactly. Yeah, as I said, and this is a PSA. Not that I'm pocket watching or shaming my any parents here or there, but it would be cooler if they're more well off. Wouldn't everyone's life be easier if they had more money? So I think it's just the most silly thing ever. And it's not as if you and me controlled where we were born to, or the family got selected into, if you will.
or if you were born, I mean, obviously we come from very amazing families. We're very fortunate. We hit the genetic lottery. We're super blessed. And I actually, in all seriousness, I actually think that I grew up in the perfect level of family success and wealth, because actually
Likewise.
when I was very young, my family had nothing, and my parents also did not hide that from the kids. So I was very aware of my parents' financial situation, and I saw firsthand the stresses that money and the lack thereof put on my parents. And so growing up, seeing that, really definitely had an impact on me. And my friends growing up knew me as being very tight with money, right? If my parents gave me 20 bucks for to go out with my friends or something, and my other friends, I mean, not to talk down on them, but a lot of them would treat that like a blank check, and they would go spend it as quick as they got it. But I would kind of hold it tight, and I would go spend maybe a couple bucks and then give the 20 back to my parents, because that was just the way that we were raised. And so, but then at the same time, as my parents became more successful and had more money to invest in us, as far as getting us the best education, getting us tutors, pushing us to pursue our goals and things like that, that can really help. So I mean, no money is honestly a good way to grow up, because it makes you hungry, but also having money also is a good way to grow up because it gives you more opportunity. So having that balance is the perfect storm. But the other thing I wanted to say is, no, there's no shame, right? If you grew up with a dad with 100 million, there's no shame in that, and go ahead and go make the most of it, right? Don't, I, I mean, obviously we didn't grow up like that, so we can't really know what they're going through, but I feel like a lot of those kids that grew up super rich, they don't want to work in the family business or they don't want the parents' money. They really want to prove themselves and make it on their own.
They
It's
have
like,
less
why make it on
purpose,
your own?
or they have so much money that life is actually purposeless. So they have no purpose
Yeah.
because there's no impact. Sometimes it doesn't even make sense for some of these kids to work if their parents are worth 100 million, 200 million, or $1 billion. In the Bay Area and the Atherton area, how many families did we know? Menlo Park, then they're probably worth $50 million plus, and their kids, they got kind of access to the honeypot and they just don't work, right? Or it doesn't really matter, or they're not really having a stable career path or job. And frankly, that will probably leave you with the lack of this. So I think similarly, my background, interesting. Obviously, turns out that my dad's done incredibly well, but you don't really know that. Your reality is your reality. But I share a room with one of my siblings growing up, where it's not like I had, my own room with my own bathroom, this, that, and 2-story massive 10,000 square foot house. No, it wasn't like that. But we obviously grew up very privileged, so you realize it more in hindsight. I think when I went to hindsight, excuse me, I realized that more so when I went to Arizona, University of Arizona, that we were actually very, very fortunate and way more than the average person, naturally. But as I said, going back to this, it'd be cool if my parents were 2 times richer. Similarly to yours, our life would be a lot easier. But I'm very grateful for what I have, and I wouldn't change anything about my circumstance. So just a little side tangent on that little topic.
We're blessed. We're blessed. All right,
Yeah.
I'm dying. I'm dying to talk about Aspire and about sensitivities.
Wait, do we want to real quick bow up and put anything else there on, the incentive for higher promote, or that's put to bed?
I think it's good. It's a good topic. We'll definitely revisit it at some point, but I think it's good for
Okay.
now.
Cool. So let's get into accredited versus non-accredited. And the reason why I want to talk about this is we have a new deal, which is a 506C, which is available for accredited investors only. So just so everyone knows what an accredited investor entails, it is either an individual who has made $200,000 or more the last 2 years and is in line to make that amount of money moving forward, or you could be a millionaire outside of your primary residence. So let's say if you have done well and outside of your home, you've invested in syndications and you've got about $1 million between stocks, bonds, syndications, and other real estate investments outside of your primary, you can't qualify to be an accredited there. But there's also a couple other stipulations to help you invest in 506Cs if you are outside of those two parameters.
So yeah, and this is actually really funny because over the holidays, I was with family and with Dasha, my sister, our director of investor relations, who I'm sure many of you know. And she was saying, "Oh, well, Aspire is 506C. How am I going to invest in it?" Right? And she was nervous because she's not accredited, right? Based on this financial criteria, which, as Craig said, you have to have a net worth over 1 million, excluding your primary, or income of 200K individually,
As an
300K for the
individual,
spouse.
yeah.
Yeah. So she said, "Okay, what am I going to do? I can't, how do I invest in Aspire?" And I said, "Oh, don't worry about it." And because there's actually the lesser known professional criteria to be accredited, which include having investment licenses like a Series 7, Series 65, Series 82, or you can be a director, executive officer, or a general partner of the company selling the securities. So if you are the sponsor and if you're a part of the sponsor that is doing the 506C deal, you can actually invest in the offering even if you don't have the financial criteria, if you don't meet the financial criteria of an accredited investor. And then this family office one's not relevant, but it's any family client of a family office that qualifies as an accredited investor. And then, so that would be like, okay, a family office entity, right? You have a wealthy family, maybe the son or the daughter or somebody involved in that family individually isn't accredited, but the entire entity, the family group is an accredited investor and therefore it's fine. And then finally, this one for investments in a private fund, knowledgeable employees of the fund. So that's kind of similar to this concept. Basically the SEC is out here to protect investors. And the way that the SEC understands or opines on the situation is that if someone works at the company that's issuing the securities, that's doing the deal, they're knowledgeable, right? They're for intents and purposes accredited. They're in a good position to make a financial decision to invest or not to invest. And so that's what qualifies them as accredited. So not to worry, Dasha, you're all good to go. And for those that also are partnering with us, or if they're doing a fund of fund that is 506c, well, you're a general partner of that fund of fund that is selling the securities that are also 506c. And therefore, if you're not accredited personally, you can invest in the offering that is the fund of fund. And then one other piece, which I know we talked about this before recording, thought that this was interesting. It's kind of a moot point because 1031 exchange investors are usually accredited because they're wealthier, right? If you're 1031 exchanging $1 million, you're gonna have a net worth of $1 million right there, right? But in any case, it's moot because a 1031 exchange investor isn't investing into the 506c offering. They're investing directly into the real estate, right? They directly own the real estate through the tenancy in common structure. So they don't have to pass any of this criteria.
Adhere, yeah, they don't have to adhere to the 506B or C, I guess, uh, umbrella because they are going directly into real estate. That's a very interesting point. But as you mentioned, if someone's investing $600,000 via 1031 exchange or 700K, 800K, you'd probably assume that they are in fact accredited or, have more than $1 million if so much of their net worth is tied up into that 1031 exchange. Otherwise, that would be kind of interesting. That'd probably be very, very rare cases if someone's going to invest in 1031 that much equity that they wouldn't be a millionaire. But hey, you just never know.
Totally, totally. So yeah, so that's interesting. So actually, the interesting thing is Aspire, which is this 506c offering that we're doing, is the first 506c offering that we've ever done. So up to this point, we've only done 506b offerings, and the difference is in the fact that a C offering can only accept accredited investors. So we are not open to non-accredited investors for this deal. And then the other thing is the accredited investors have to be third-party verified. So there's an extra hoop to jump through for the investors. So unfortunately, I apologize in advance for the hassle that any of our investors may experience here. We're partnered up with Appfolio, which has an integration with a third-party verification service. Also, to help investors out, this is a really important update that happened, I think, at this point over a year ago, but you can actually get a letter from your CPA that states your accredited status, and that single letter is valid for 5 years. So you don't have to mess with it a bunch of times. You can just go ahead and get that letter from your CPA, and that's it. You're done. So that helps with the third-party verification process. And then finally, the big difference between B and C is that we can publicly advertise a C offering, but we can't publicly advertise a B offering. So if we were doing a 506B for Aspire, we wouldn't be able to talk about it as freely as we are right now on this podcast. We would have to say, hey, we're going to talk about a new deal that we have, but this is not a solicitation for investment. And we would just kind of talk generally about it without soliciting investment. But because we're doing a 506c on Aspire, we can openly say on this podcast, as well as on social media, et cetera, we can say we're open to investment from accredited investors. This is a 506c offering, and so on. So that's exciting. With that being said, we don't necessarily plan to be super public with our solicitation or our offering, but definitely would like to run ads at some point and give that a shot. So it opens up some new opportunities for us.
Yeah, and I think that some people will not like the C nature because there are a couple more hoops to jump through. And if you're creating a fund, it can get a little bit choppy because obviously people's funds, can be varying depending upon how they want to structure it. They could be more or less generous to their partners, depending upon their investors, excuse me, depending upon how they want to structure it. So it does kind of create some, murky-ish waters, but that's something we'll figure out in real time. I just want to, note this property. If you're going to raise equity on this deal in Inspire is in San Antonio. It's in an incredible location with lots of upside here. We're getting this for an incredible deal. The going in cap rate is impeccable. So if you're a fund manager, capital raiser, or have a 1031 exchange coming up, I don't think you'll qualify for 1031 exchange on this opportunity, but please let me know. Reach out to me. You know my email, but once more, it's Craig at lscre.com for the 1 billionth time on the show. So yeah, if you're looking to raise equity, looking to invest in it as an LP, or just looking to learn more information, please email me. Email once more is craig@lscre.com for this deal. So why don't we get into kind of just the quick breakdown of this opportunity? So it's a deal in San Antonio. Rents going in are stabilized, or sorry, the trailing 12 is about 941, and we're going to stabilize the rents at 940, which I absolutely love, especially in a recessionary environment. And that's still getting us to roughly about just shy of an 18 IRR and a 2.1x equity multiple. The cash on cash about 8.3 projecting for our investors there, which is just great. Now, Rob, is this set up right now for a Class B investor or Class A share? Because I see $1 million is in there, but sometimes on our sensitivities, it changes roughly. But if you're a $50,000 investor and you are in fact accredited and you're looking to make some, earlier investments, we're looking at, roughly a, 2.1 equity multiple. So roughly if you were to invest 50K over the 5-year hold, you get around $20,000 in distributions on monthly distributions, which we do. We also do monthly reporting. And then your back end equity would be about 84K. So 50 grand would turn into 84 over a 5-year hold, coupled with cash flow. So basically your 50 grand would turn into about 105K over that whole period, which is really remarkable. And this deal is in San Antonio. We really like San Antonio. Obviously Houston we love as well. But the issue with Houston, of course, is the fact that there are some weather issues and hurricane issues with for insurance purposes and whatnot, and that do make it a little more challenging. San Antonio insurance is a lot more reasonable, and we do want to provide our investors some geographical diversity within Texas. So this adding this submarket here will be really great. This does have a bit of a tax abatement nature to it. We don't want to go talk about it too much, but this falls directly in line with what we are already managing in our Houston deals. So this is kind of just a perfect storm of a Lone Star deal with kind of the complexities that we typically do. So really a ton to love here, raising about just over $9 million. As I said, if you want to get in on this opportunity and raise some money, don't know how much space will be by the time you reach out to me, but if you are listening to this, please reach out to me and we can figure out maybe a solution to have you bring some equity in and partner with us in this deal, or you could use this as a launch pin or launch pad to our next opportunities that we are doing this year, because we will be doing many deals.
Yeah, very well said. Good overview of the deal. Some things that I love to echo what you said is this right here. This is not a value add deal. We're not pushing rents. We're not trying to re-tenant the property and change demographics. So from an operation standpoint, I wouldn't say it's low risk because we're still talking about a Class C property. So this is a property that's going to have the typical Class C challenges of higher turnover. We have to clean up some crime, deferred maintenance. There's definitely some work, but that's where the opportunity is. We're picking this up at a discount. This is a 76,000 per unit basis. That's a really attractive basis. But we're getting it for cheap because of the market timing right now, as well as for the fact that the property is in poor condition. There's going to be some renovations that we're going to need to do, but we're just getting the deal up to par. It's not like we're buying a clean asset and then going and trying to stack another renovation load on it and then raise rents $200, right? We're basically buying it here and then we're bringing it up to market par and not trying to completely re-tenant and reposition the properties and its versus its competitive set. So feel really
Yeah.
good about the going in basis, feel good about the exit. This exit right here of 100, just shy of 118,000 per unit is at a projected 6.5% exit cap, which I'm getting, I don't know how I feel exactly, but I'm getting more bullish on the fact that cap rates are going to recompress. I don't think they're going to go back to, twos and threes, but could we see fours and fives? Absolutely. So I think that, like you said, 2024 is going to be a fantastic year to invest. And this is the time to plant your seeds. Plant your seeds, invest a lot of money, and be prepared to reap in 3 to 5 years what you sowed. And that's, yeah, that's the name of the game.
Yeah, and I just want to mention this too. We spoke about this earlier, but uh, it's going to be potentially choppy, as I mentioned, with the market coming up, and a deal like this will attract, some turbulence naturally, probably in the front end. So if you're an investor, bear with us. But the cash and cash here is great. We will undertake some issues here. Obviously, the first 24 months, the stabilization period, may be pretty tough for us, but we think this deal is worth the risk. when you go through the profile of it. So I think this episode, it's kind of encompassed so many great things leading into this conversation on the specific deals. So we really did tee that ball up nicely, so to speak. But let's kind of get into some of the things that we're going to do on this deal. So you see physical vacancy at 10%. Historic occupancy on this deal is about 93% over the last 30 years, I believe, which is incredible. So we're going to bump that up there. There were some issues with some units going offline that had kind of affected organic occupancy on this property. So that will go up in our hold period. That's a benefit to us. Some other assumptions here, rent growth annually, 3%. I believe ERD is posting about 4%. So we're doing 3% there. What's our entrance cap on this one, Rob? Does it say here on the
Yeah, so
operating cap?
our going in cap is 743 or 7.43%, and that's post partial tax exemption. So like you mentioned, this deal has an affordable component, which is really we kind of buried the lead a little bit because that really is the element that underpins these returns and the business plan here. And that's how we're able to buy a deal, not push rents, keep the property stabilized, fix up deferred maintenance, and still project mid to high teens returns. And so we're getting a partial tax exemption through a nonprofit partnership. And that, like you said, this is in line with now we have 9 deals in the portfolio that have tax exemptions and an affordable housing component. So this is at this point baked into the Lone Star DNA. Kent, as many of you know, is my business partner, and he's formerly a tax attorney. So he's really dove in and uh, made magic with some of these strategies and stuff. So it's some really exciting stuff, and that's what is allowing us to go in at such a high cap rate. Because if we were buying this deal at a let me just actually back it out. So if I were to just take the taxes and back it out and just say that we're paying full boat on taxes, it's actually only a 6.2 cap going in. So, which is not a bad cap. I mean, you're over a 6, which is great. And also, we're totally sandbagging this interest rate because rates have fallen a bunch since we put the deal under contract. So we should actually be able to get a rate that is below 6, which is fantastic. But yeah, going in at positive leverage without the tax exemption, and then you layer in that 50% tax exemption, and now you're going in at a 7.43% cap, and we'll probably finance the deal. I mean, who knows? Rates have been volatile, but let's say we lock the rate at 5.8%. That's some really, really powerful
Those are
positive leverage.
rollonomics. Those are
Yeah,
rollonomics. Very close to
Rollonomics.
Jamie rollonomics there with 150 points of a spread. So that could be awesome if we could achieve that. Granted, we are, as you said, not sandbagging was in reference to the debt going in, which is nice to have it higher than what it actually will hopefully end up being. That's actually a change of fates, as many people know that have invested with us over this last year and who have been just tracking investing in deals as debt has blown up many people's sunny days and whatnot, adding some turbulence there. But having that on the other side is great. So close to the 150 points of spread that Rollonomics would provide. But I do think, considering that this is an abatement, that kind of cheats the system ever so slightly. But for us, it's incredible. And getting almost 150 points of positive spread really helps the DSCR on this deal, and helps us kind of lever this deal at a comfortable rate where we don't feel it's being too aggressive. Considering going in, we would be at positive leverage. But just to get a deal that has this upside is really, really great without having to push too hard. As I mentioned, stabilizing rents $1 less than what they are right now in a looming recession environment, but in a growth state, makes me feel very comfortable. So I love that. But you know what? I think what we should do real quick, while we're in the spirit of talking about sensitivities, talking about how you can kind of skew the numbers, and talking about how we get paid on our returns and the waterfall and whatnot. Can we play with a couple of projections and simulations just to show what some people are doing and how we do things differently? If we go to the inputs tab, please. So a lot of people are putting rent growth in of 6, 7, 8%, which is nuts. But when you do that, it's really challenging, and not obviously upping their expense ratios, or they're putting in a potentially bogus exit cap, right? And when you do that, you really change the numbers. So if we wanted to play the game that a lot of other sponsors get, this deal really shines. So let's say, why don't we change your debt real quick to let's just go best case scenario. Why don't we do a 5.8% interest rate? Okay. Then why don't we go to, on rent growth, why don't we do 6%? because we're feeling really great about ourselves. And when we do expense, when we do 3.5, we'll change that ever so slightly too. And then exit terminal cap. Why don't we go crazy and do 575?
Yeah, which I think is the least crazy of what you, well,
I
aside
don't
from
think
the
I
debt.
don't think yeah, I don't think
575
that's
is
not
not crazy, frankly.
okay. Yeah,
But it's
but
fine,
let's
but
just
it's
say
fine.
that
It's very
yeah.
good.
Yeah. So let's say all those things happen. Now let's go to the summary of the deal. So it was a 17.8% IRR. Oh, well, now all of a sudden it's a 27 IRR. So these are some of the games that people play. I just want to stress this point so much that everyone's underwriting is different, and you are going to get a different cake and a different cookie if you bake with a different sponsor. And this is the result. So we've really handicapped our numbers on this one ever so slightly. I think they're very, very fair. But if we changed it, look at the IRR. Okay, but let's go now. Go back to the input section and let's just go more modest on, let's keep the cap exit there, but let's keep, let's keep that there. Let's keep expense ratio let's keep it at 3.5 and let's go to 3% on annual rent increases. So let's go 3.3 on both, actually.
Yep.
Okay, 3.3 on both. We're still getting a 21 IRR with that exit cap there. So, and now let's go the ladder on inputs. Let's go exit cap rate of 7%. So in the world in which we're exiting a not so favorable environment, we are still getting a 16 IRR. That is incredible. So, of course, we don't know what's going to happen. It's all about protecting your downside, but look how awesome this deal is. And then also, I just want to show how much, ultimately those sensitivities will change the parameters of the deal. So, I just want to stress this. Don't get oversold on the underwriting, get oversold on the sponsor and their conservative underwriting with the potential outcome that the deal could be a lot greater otherwise.
Yep. Love that. Really good points that you're hammering there. So the and we can maybe we'll see how long this takes, and we could perhaps do an even deeper dive into sensitivities. But what Craig just did there is frankly how I think about sensitivities is I don't love these sensitivities tables. Investors, a lot of investors want them and they expect to see them and they're like, hey, where are the sensitivity analyses, right? Because they're kind of looking to check a box and they kind of want to perfunctorily check their downside protection, right? But for me, when I'm actually looking at a deal, I actually kind of just manually change the inputs and tweak the numbers and play with the downside there. But with that being said, sensitivity tables and analyses are actually a very valid way to do some of the things that we just did. For example, instead of playing with the inputs, someone could simply, because a lot of people aren't as comfortable playing around in the spreadsheet, they're worried about breaking something and
Some
uh,
people think it's locked too and don't know how to access it, which for the record, it is not locked. Our spreadsheets are not locked. How did someone, Rob, access your incredible proprietary underwriting model that's been downloaded how many times now? Maybe 20, 30,000 times?
No, over 10,000 times at least.
Okay.
But
I'm
yeah, so
embellishing.
people email us all the time saying, "Hey, the spreadsheet's locked. Would you mind unlocking it?" Or, "Hey, I can't use it." So all of these tabs, while they do show as locked, it's because the calculation cells are locked because we don't want people to break anything. But for example, this is not a calc cell. This is an input cell, and that's why it's an orange number. So you can change it and you can go like that, right? And then similarly, if you want to actually unlock the page, you can go ahead to the review and hit unprotect. There's no password. And but we just protect, no password, okay. And there you go. Everything is great. So all these things can be unlocked just via the unprotect sheet. But anyway, that's not the first time we've said that, and it certainly won't be the last, but no worries, we won't hold it against you. But what I wanted to cover here are, yeah, the simple sensitivity analyses. I want to encourage people to actually look at the spreadsheet, even if you're not quote unquote underwriting a deal, just being comfortable to look at the spreadsheet and the model is really important. So, for example, and we do apologize if you are listening and not watching. This is not going to be great,
Very bad
but
radio.
very
Very
bad
bad
radio,
radio.
but hopefully you
Yeah.
get something out of it. But just as an example, right, the base case of 3% rent growth and a 6.5% exit cap, here you have the projected return. And then if you go to 4% rent growth, right, which is what Yardi's projecting, and if you keep the exit cap the same, it's a 19.6% IRR. So it's very easy to see and check this out. And you can say, okay, well, what if it is that 575 exit cap that we were talking about, but all else stays equal?
Huh.
Okay, 20.7. There you go. Well, what if it's a 7.25 cap, which is, who knows what happens? We don't know the future, but frankly, that could be a doomsday cap.
And a
And
2% rent growth because we're in a recession.
yep.
Okay, well, 12 IRR on your downside is really not that bad.
And the problem in that situation would be you're a forced seller. You would only sell a 7.25 cap if you had to sell for some reason there. So that's another important element there. But nonetheless, it's informative, it's interesting. What I think, however, are the two most valuable pieces of information here are break even
I love
occupancy,
this. I
right?
love this.
This is
Yes.
great. And investors ask us a lot, hey, what's the break even occupancy? People want to know that. And so the funny thing about break even occupancy is there's not one way to calculate it, right? There's different ways that you could calculate it. So if you really care about this metric, you probably want to not just accept the number that's being given to you by your sponsor at face value. You probably want to dig in and understand how those things are calculated. And just to be honest with you, looking at this formula, I don't remember exactly how we calculate it. Just trust me, I've put in a lot of time and thought into how to best calculate the break-even occupancy. But if you want to call us out and know, trust me, we'll dig up the formulas and tell you exactly how we calculate it. But the
And
important
I would
also,
want to calculate it real quick. I would want to calculate it on, okay, break even. Well, if my rents drop $100 across the board, what does that do to my DSCR? What does that do to the break even occupancy? Where does that go if rents truly soften to that degree and concessions are crazy? So, that's what I would want to look at in this kind of current environment is, hey, ooh, break even. Well, actually, if it's minimum, on a call it 76.3%, well, maybe it's actually closer to 85% if rents drop $100 or whatever it may be. So just to understand, and I think right now in this environment, don't chase the highest yield. Just figure out because every deal I think will do well with a good sponsor. What is my downside and worst case scenario to invest in this environment?
yeah, that's great stuff. And also the other element of break-even occupancy is when. Is it day one, month one, year two? Is it stabilized? Is it untrended stabilized? Is it trended? So if you're just saying, what's the break-even occupancy on this deal? I don't know. What are you talking about? So what we provide to investors is what you see here if you're watching, which is the month one break even occupancy, the year one break even occupancy, and year two. Because your break even occupancy could look great if you're also projecting to raise rents $400, which is totally wrong and out of market, right? But oh, the break even occupancy checks the box. So it's not perfect. No one metric is perfect, but these are good things to just kind of sanity check and to stress test, right? But now here are the big guns. So the big guns are the refinance exit test. And so, or just commonly known also as just an exit test. And this is more of a lender driven analysis. So anytime you've ever gotten a loan for multifamily, the lender performed an exit test to feel comfortable with making that loan. Because basically, what an exit test is a lender is making the loan today, and they want to feel comfortable that you're going to be able to pay off that loan at some point. And so a lender would prefer you to be able to pay off that loan with a new loan rather than you having to sell because that means that their LTV is very high. So but from an owner perspective, it's even more important, obviously, because we're taking more risk as the equity of the deal and not the debt. So a refi exit test is even more important because this is how you avoid capital calls. And let me just walk you through this here as well. So in the base case, prior to a refi, and this analysis is done 60 months from now because the loan that we're doing on Aspire is a 5-year loan. So 5-year
Fixed
loan,
rate, 2 years interest only.
that's exactly right. And so a 5-year loan is riskier than a 10-year loan. Okay. But there are pros and cons, and we don't need to litigate that or go into a whole discussion on that. We decided that a 5-year loan is perfect for this deal. We feel confident in that. And this refi exit test is a way for you to also get comfortable with the risk of the debt in this scenario. So with 5 years down the road, we're projected to have a $2.6 million NOI, which if you cap at a 6.5% cap rate, that's a $40 million valuation on the property. And we'll have a current loan of 20.6 million. So if we refied in that situation at a 6.5 cap value, right, that would be 40 million. And if we did a 75% LTV loan, it would be a $30 million loan. And that would be 100% cash out, right? We invested $9 million into the deal. We got a $30 million loan. So we'd be able to pay off the $20 million loan and return all capital back to investors. So that's a home run on the base case. However, let me also point out that that's at a 1.2 DSCR, so it's a little bit tight. So maybe we wouldn't want to fully cash out and take the 30
100%
million
out. Yeah.
dollar loan, right? Maybe we only take a $28 million loan or something like that. So that's just something to be
And,
aware of
and
there.
And also, it's funny, we may consider what the debt market and the capital markets are like for our debt profile. We may consider taking on only $10 million, but doing floating rate debt on this deal, which is a little more risky, but we have so much cushion with our DSCR that might make sense, right? So there's so many angles you could take it on, this point of the deal if that much value has been created and we do that well. But my guess is we would likely sell if
That's
we were about
right.
to double our money. So it's kind of a moot point to go over this, but this just kind of shows all the angles that we really look at Lone Star here because we really do think about everything. I think, as I said, it's about the jockey. You're betting on that and the fact that in that obviously it's the sponsor and the market. So if you believe in both those things, you should really, should hopefully feel very solid about your decision with where you park your capital, not really chasing the highest numbers.
So now let's look at the next column here, which is the operational shock. So we covered the base case, and obviously base cases are always rosy. So now let's look at an operational shock. And in this operational shock, we're actually reducing revenue by 10% off the pro forma, which results, because revenue is typically about double your expenses, that results in about a 20% decline in income. So instead of a $2.6 million NOI, we're actually at 2.1 million of NOI. So at the same cap rate of 6.5, which again I think is pretty conservative, that brings the valuation all the way down to 32 million. That's a huge hit to the value of the property. And so if we needed to finance on that valuation at 75% LTV, it would be only a $24 million loan, which is not as exciting of an outcome, but it is more than enough to cover the existing debt. So there would still be a substantial cash out refi in that scenario. No capital call, no issues there. So now let's go to the next column, which is the capital markets shock. So instead of the operational shock where we shocked the NOI, we stress tested the NOI. Like you said, oh, I want to see what happens if we knock rents down $100, right? That's a big hit. Well, the capital markets can also hit your valuation, meaning you can have the same exact NOI that you projected, but if cap rates are higher, interest rates are higher, it's a less attractive environment to finance in. That's also going to affect your outcome. So if we take our base case NOI going back to the 2.6 million, but we stress test the cap rate and we take it to a 7.15% cap rate, that's going to mean the value of the property is now 36 million and change, not the 40.
Still $10 million of an increase, which is a very, very solid investment coupled with your cash flow. So that's not that just, oh yeah, hey, it's only worth 36 coupled with the cash flow. Hey, $10 million of value increase there with your cash return with a levered asset. That's a pretty darn good return on the, market shock.
Yeah, feel very comfortable there. And you get a loan at 70%. This is the other important part of the capital market shock is we shock the interest rate higher and the LTV lower. So instead of getting an 80% LTV loan, which helps cover your existing mortgage, you only get 70%. That's still a $25.5 million loan, which more than covers the existing $20.6 million loan. So everything is fine there. But here's where things get sticky is when you shock both the operations and the capital markets. This is a very, very painful stress test that the vast majority, I would say 9 out of 10 deals that people are investing in these days or at any time doesn't pass this shock because it's quite rigorous. And this deal actually, frankly, fails the both stress test. So let's go through it. So we shock the NOI down 20% to 2.1 million. At the same time as the NOI is down, we pop the cap rate that NOI is valued at, same as the capital market shock, to 7.15%. So now the value of the property is only 29.4 million. Still more than we paid for it, but that's pretty much break even if you look at our all-in basis on the deal. Our all-in basis is 30.5 million. So in the both scenario, our property is worth less than our all-in cost basis. That's not a good situation. And if we're only able to get a 70% LTV loan on that, that's actually a $20.587 million loan, which is just a hair below our existing loan amount. So technically speaking, we fail this stress test. However, with the caveat that our DSCR is actually 1.33x, which is quite strong. So, maybe we're in an environment where the lender is very conservative and they're not willing to finance based on a 1.25 minimum DSCR. Maybe it's 1.3, maybe it's even 1.35, and that's a really ugly situation. Fortunately for multifamily, we have Fannie Mae and Freddie Mac. That could change, but those are government-sponsored enterprises that really provide liquidity when there isn't any. I mean, they provide it in good times, but particularly in bad times. And so they don't change their underwriting metrics a ton, even when there's bad things going on. So just to fix this issue, we could take it to a 72% LTV. And you can see now we're at a 1.3 DSCR, which is really strong. And our loan in the both stress test actually covers the the current loan amount. So we pass the refi exit test. So that's very exciting. And voila, there you have the refi exit test.
I love it. This is so thorough. This is so comprehensive. And as I said, check your downside. And if this deal, I mean, the reality is this: if both occur in the stress test, it is not isolated and just subject to us. There is likely more of a black swan event that occurred that would create such a environment where this is going on. But it is nice to know that your sponsor is thinking this way in regards to how we look at everything. Also, I think it is interesting to look at, the IRR and the exit cap based upon that. So you could have a higher IRR and a shorter hold period, but have obviously a lower equity multiple, right? So do you want to just real briefly get into that kind of nuance?
Yeah, sure. I mean, hold period has a big effect on your projected IRR. And that's especially true as the hold period gets shorter and shorter, right? The IRR between a 4 and a 5 year hold period, if you just look at the base case, right, 18.7 versus 17.7, that's not a huge deal. But as it gets shorter, and we don't actually underwrite or really look at anything shorter than 3 years, but you can see the difference between 3 and 4 is bigger than 4 and 5. And then obviously, right, if you logically extrapolate to 9 year hold period versus 10 year hold period, it's a very, very slight difference. So IRR decays with time. That's just what it is. It's hard to compound at very high rates of IRR over a longer period of time. That's why you typically get in and get out in a 3 to 5 year period to really maximize your returns over time. But again, getting in, getting out, it's a lot of work and it's more risk, and there's more potential tax consequence if you aren't thoughtful with 1031 exchanges and depreciation. So, however, with that being said, like you said, with shorter hold periods means higher IRRs projected. And like I said, people that were exiting deals in 14 months, 18 months, 24 months, they were posting some really high IRRs, but their equity multiples weren't necessarily tremendous.
A
I mean,
2x, yeah,
it could still be very good. I mean, a 2x in a short amount of time, I'll take that all day long.
everyone
But
would.
you need to dig in to, you know, like we talked about earlier, not one number is going to tell you the full story. You really need to dig into the nuances.
As we all know, you can skew stats any which way you like. If you're a politician, left or right, you can skew any stat or number to make it more favorable to kind of achieve your narrative that you want to put down people and kind of cement in people's brains. So that can change really quickly depending upon ultimately how you want to play with the numbers. Other sponsors want to highlight different, things and I guess components that make their underwriting and deals look really good. We have some people who work with a lot of our competitors who ask questions that are more skewed to them, which is understandable. That's kind of the metrics that they go off of. And we appreciate that. And I'm sure we go off of numbers and use numbers that, people are like, oh, well, obviously use that metric because X, Y, and Z, it's beneficial for them. So that's something to think about. Also, something to think about too is when we see rent growth and it's 3%, it's not just, oh, well, 5 years, 15. No, that 3% is cumulative and compounding and stacks off one another. So it could be really closer to 17% or whatever it may be. I don't have a compounding interest calculator baked into my brain, but naturally that's something to think about. Also, just a PSA, if you are doing a deal and are going to invest in a deal, make sure you understand the preferred return. Is it cumulative and compounding subject to 100% return of capital? Or are they kind of playing with semantics there with regards to how that preferred return is actually accounted for and distributed? So just some things to think about for sure is that.
Another point on the rent growth, and I think this is a long episode, so I'm sorry for everybody, but really appreciate it if you're still with us. And I think we definitely saved the best for last because that refi exit test stuff is really important and something that we want to definitely hammer on. But the other point on rent growth, like you said, is it's compounding. it also doesn't move in a straight line. Just because we're projecting 3% annual rent growth doesn't mean we stand firm in our belief that every single year of this hold period and of this investment, rents are going to grow 3%. That could look like zero over the next 2 years as things are soft, but then things pop and rebound hard, and we might get 1 year with 8 or 10, and then things moderate, or who knows how it goes. We feel
I
confident
love this.
in the thesis, in the location, and in the fundamental demand, supply and demand dynamics here that we think over the long run it will work itself out. But no, we don't think that necessarily rents are going to grow 3% every single year.
Well, and it's not linear, right? Think about COVID 2020. There's probably 0% rent growth. There maybe was negative for a little bit. And then boom, most markets probably saw 17% rent growth. It's like, okay, well, over the course of 2 years, 3 years, there's your 3% if nothing grows more deeply there. So as you said, these things are not linear at all. And you just got to go with it. Also, our cash on cash perspective can also change. We're projecting, slight increases and bumps, but just on some of our deals, I want to exercise some patience to some of our partners and future partners. We hope to hit the rent increases. Let's say year one is showing 6.5%. Well, that doesn't necessarily mean that automatically year two, we're going to hit 9.5%. We may increase it to 7.2% because maybe stabilization is taking longer. Maybe the submarket is growing a little more slowly, or we feel as if internally, hey, we could distribute that extra percent or two, but we actually think it's more wise to hold that money for a potential CapEx improvement. If there was an unseen experience that we have seen on the asset management side, that we know that capital would be best allocated towards enhancing the property for the terminal value of the property. Those are the items that do come up. So although this is projected, that is by no means guaranteed. The G word does not exist in our repertoire in reference to how we present our opportunities and investments. So our partners that are listening, one that maybe think, oh, well, year two said it was going to be 8%. Is that what it means? No, not necessarily. Would obviously love to distribute as much as possible, as that will pay down our preferred return, the cumulative compounding nature of that. But just know that it doesn't necessarily mean that cash on cash return is going to be hit every single time as it's shown there. These are projections for the better or worse. That's what they are. So understanding these sensitivities as an investor, as a capital raising partner is so crucial.
Love it. Love it. All really good stuff. So that's pretty much all I have for us today. I don't know if you have any other
Yes.
thoughts.
No, closing thoughts is this. We have very ambitious goals. We're planning on doing $300 million at least in the new year, which equates to about what? Just around $70 million a
75
quarter.
per quarter.
75 a quarter. Okay, yeah, quick math. 75 a quarter there. So we need people's help here to achieve that. We're really appreciative for the following that we have here. Those who are listening, we don't get the most views in the world, but the views that we get are very impactful. So thank you so much. But if you're looking to maybe work with us on this Aspire deal or maybe a new deal in the new year and you haven't connected with us, you've kind of been watching but haven't, kind of engaged with us, please do engage. We're looking to grow our network and our capital solutions and to have the most robust bullpen of equity partners possible. We don't just do institutional equity. We have a very wide array of opportunities that we invest for and deals and kind of places where the capital stack makes most sense for more of, kind of boutique capital partners as opposed to the institutional people. So please reach out to us if you want to, as I said, raise on this deal or learn more about it. If there's space for it, as there may not be space by the time this deal or this is published, please let me know, but reach out to me, Craig at LSCRE.com. Just want to close it. Thank you so much for those who have also been listening to this show for the last half year we've been putting it out for. This is something I, really am proud of in the sense that it's gone very, very well. Honestly, better than I was expecting with regards to engagement and people reaching out to us. We've met people from basically doing this podcast. We've converted investors from this podcast. So to those who are in those camps, you know who you are. Thank you so much. And if you think this could be valuable for anyone else in your network who is looking to learn more about, commercial real estate, specifically in the multifamily world, and wants to hear really from one of the best and brightest brains in the business, which is Rob, please share the show with them. The more the merrier. And as I said, if you're looking to invest, you know where to find us.
Love it. Good stuff.
Yeah. Yeah. Well, peace, love, and prosperity to everyone in the new year. Happy 2024. Happy New Year. And we'll catch you on the next week's show.